In this example, we are going to be looking at the FIFO method used in accounting for costs. So you can see in front of you a series of transactions of merchandise that we purchased throughout the year. We start with our beginning inventory, and then it gives you a list of all the units that we bought and how much we bought them for. So you can see as the year went on, the unit price increased. That's our cost. That's what we spent on the items on an individual level. And then so we have our total cost. So FIFO, what FIFO means is first in, first out. And that's how we sell those products. So the first ones we bring in are the first ones that we sell. So for example, we sold, the first items we would sell would be these 400, and then these, so on and so on. So the items that we would have left in our ending inventory would start from the bottom. Everything we didn't sell would be left in our ending inventory. So let's go through and see how we're going to calculate our costs under the FIFO method. So the first thing we do is we know how many units that we sold, and we need to count up those total units until we get to the total price that we sold. So we sell from first in, first out. So if we sold those 400 units at $20 a piece, that's $8,000. So if we sold them, they're in our cost of goods column and not in our cost of inventory. So they can only be in one or the other unless we split them up, which you will see that here in a minute. So cost of goods sold so far is $8,000, and we don't know our ending inventory, but there's nothing left. We sold all of those units, so nothing from our beginning inventory is going to be calculated in our ending inventory. Then we sold the 500 of the units that were purchased from the first, so there was only 500 there. We sold all of them, so none of them in our ending inventory. Then we sold all 200 from our second purchase, so there are none left in our ending inventory. And then we sold all 300 from our third purchase at $23 a piece, so there's nothing left of those in our ending inventory. And then on March 7th, the fourth purchase, we ended up selling all of those, 900, $24.50 a piece, so none of that is in our ending inventory. And then on the 5th is where we only sold half. The fifth purchase on June 2nd, we only sold half of those items. So 400 of those go into cost of goods sold, and the other 400 go into our cost of our ending inventory. So then from this point forward, everything else is in our ending inventory. So from our sixth purchase, we still have those left to sell, so they're in our ending inventory. And from the seventh purchase, we still have those left to sell, so those are in our ending inventory. And so then we can calculate, we had a total of 2,700 units. 1,300 of those units are in our ending inventory, so that means we sold the remaining 1,400 units. So here's what we have in our ending inventory. We have 1,300 units left for a total cost of $34,100. And in the FIFO method, we keep them separated out. We don't lump them all together, because when we sell them, we want to make sure that our cost is recorded for the actual cost that we purchased for them. So then our cost of goods sold, after we add everything up here, our cost of goods sold is $61,500.